Today we are going to talk about deferred taxes. Imagine you are the manager of a corporation. At the end of the financial year, you realize that your corporation's profit on the financial statement differs from that on the tax return. Now, you wonder about the reasons for this discrepancy and its implications from a tax perspective. Differences between accounting and tax profit primarily arise from timing differences in recognizing income and expenses for accounting and tax purposes. To account for these timing differences, the concept of deferred taxes is applied. Deferred taxes can be classified as either a deferred tax asset or a deferred tax liability and are recognized on your corporation's balance sheet. Let's first talk about deferred tax liabilities. A deferred tax liability represents a future tax obligation. It arises when your corporation's future taxable income is expected to exceed its future financial income. On the balance sheet, this deferred tax liability is recognized as current or non-current, depending on its expected due date, and it increases your corporation's effective tax rate. An example leading to a deferred tax liability is different depreciation methods applied for accounting and tax purposes. Imagine your corporation uses straight-line depreciation for accounting purposes while the tax authority employs the declining balance method. In this scenario, the depreciation expense on the financial statement is lower than that on the tax return. Consequently, income on the financial statement exceeds that on the tax return, and in the future, a tax liability is expected. Let's now talk about deferred tax assets. A deferred tax asset is the opposite of a deferred tax liability. It represents a future tax benefit and arises when your corporation's future taxable income is expected to be lower than its future financial income. On the balance sheet, this deferred tax asset is recognized as current or non-current, depending on when it is expected to materialize, and it decreases the effective tax rate of your corporation. An example leading to a deferred tax asset is a tax loss carryforward. As explained in another video, tax losses of the current year can be offset against taxable profits in subsequent years. Such a loss carryforward reduces your corporation's future tax liability and, thus, results in a future tax benefit recognized as a deferred tax asset. To summarize, deferred taxes are an accounting concept that accounts for temporal differences in recognizing income and expenses for accounting and tax purposes. A future tax benefit is recognized on the balance sheet as a deferred tax asset, while a future tax obligation is recognized as a deferred tax liability.